Hi, this is Davin Clarke from TradeDirect365. I'd like to thank Alan Oliver for his webinar on the numbers that govern our lives. Before we get started, we're just going to run through some bonuses that we've got for TradeDirect365 clients that open accounts before the 20th of December. First of all, there's a bonus $100 credit added to your balance on opening an account. And also there's a $365 trader safety net. For the first 30 days of trading, we cover losses up to $365. Conditions apply, so check our website for details. Now, the other thing we want to just quickly run through is some of the benefits of TradeDirect365. We do have commissions cheaper than anyone else in the industry at 0.07%, and we've also got very tight spreads which are fixed 24-hour with no commission. We've got 550 ASX shares. They can be traded both to the upside and the downside. We offer guaranteed stop losses on over 250 stocks. We've also got an intuitive and very easy to use platform. Okay, that's enough from me. Now we look forward to listening to Alan Oliver and his webinar on the numbers that govern our lives. Thanks very much.
Ladies and gentlemen, what we're going to do for you this evening is to give you a presentation that I did for the Australian Technical Association membership around Australia. Unfortunately, some people just couldn't attend, but obviously for overseas people, and there were quite a few requests from people who actually wanted to see what the presentation was all about. So what we're going to do this evening is to cover two birds here. We're going to have a look at what Davin had to show with Trade Direct, and we're also going to have a look at the presentation. So what we'll do is just get straight into it. The first thing that obviously I should point out to you is that this is primarily some information with respect to trading techniques, strategies, trading signals and so on. But it's important to point out that I'm going to not give you a trading plan. I'm not going to talk about money management or the psychology of trading or any of those market specific details. What we are talking about here entry and exit strategies and patterns and techniques which were used by Gann and Fibonacci. So primarily that's what we're going to be looking at tonight. The charts that you see were actually from a program called Market Analyst, and I attended one of their conferences last night, and it was fabulous. They've got a lot of new developments in that program, and it was just fabulous to be there. What we are going to do this evening is to look at two of the greatest trading / mathematical minds that have been a big influence in my trading, and that of course is Fibonacci on the left and WD Gann on the right hand side. And what we're going to do is to go through a fairly brief yet detailed explanation of what these two people mean in terms of how I use them in trading. Now, Fibonacci was a talented mathematician, and he wandered around Europe with his father, who was a customs officer. And primarily what happened was that Fibonacci did a lot of work on the pyramids, and he found that there were certain numbers and certain codes in the pyramids that he had found in nature itself. But the essence of the code is that there are specific numbers which seem to repeat in nature. Nature's obviously using this mathematical code in its construction. And the process of getting to the numbers is quite simple. What we do is start in 0 and 1, and we simply add 0 and 1 together to get 1. So we just add the two numbers together. For example, 1 plus 1 equals 2, and 1 plus 2 equals 3, and 2 plus 3 equals 5, 5 plus 3 equals 8, and so on. So the numbers can be quite easily obtained by simply adding the two preceding numbers in the chain. And it's these numbers that you'll find are very relevant and very prevalent in nature and in its construction. Now, what I've got here is an X-ray of a hand. Now, the X-ray of the hand is particularly interesting because you'll see that we've color-coded the bones and the length of the bones inside the hand. Now, the first bone tip you can see measures 2, and then the next bone measures 3. Now, 2 plus 3 equals 5, which is the distance of the green bone, and 3 plus 5 equals 8, which is the distance of the blue bone. So what we've got is the bones within our hand are working perfectly to the Fibonacci series. And it's these numbers that you'll find in all sorts of places. You'll find them in trees and in pine cones and lots of different things. What we're more concerned with is the numbers themselves. And when we go back to that chain of numbers, 0, 1, 1, 2, 3, 5, 8, and so on, we get the numbers by adding the two previous numbers together to get the next number in the sequence. For example, 5 plus 8 equals 13. But we also get very important ratios of the numbers. For example, 61.8% is the relationship between a number and the next number. So 89 is 61.8% of 144, and 55 is 61.8% of the next number, which is 89. So what we've got is this sequence of numbers, and we also can use the Fibonacci ratios to go forwards in the chain. So for example, 89 multiplied by 1.618 gives us 144, and 55 times 1.618 gives us 89. We can get the numbers by two ways. We can take a number, multiply it by 0.618 or 61.8% will take us backwards in the chain, and 1.618 or 161.8% will take us forwards in the chain. And those are a couple of crucial things to remember. Now, as I just mentioned to you, nature uses this mathematical sequence in its construction, and here again is another fabulous example of the Fibonacci construction. For example, if we measure the length of a hand and multiply that by 161.8%, what we get is the next major join in the arm at the elbow. Again, another fabulous example of nature using these Fibonacci numbers in sequence. And if we have a look now at this bird, what you can see on the bird is that the head of the bird, if we take that measurement, multiply it by 161.8%, we end up with the change of the bird's breast from blue to yellow. So I just thought that was really interesting to give you a couple of indications of how these numbers are worked in nature. Now remember, we said that Fibonacci, as a mathematician, spent a lot of time going around Egypt with his father collecting taxes as a customs officer. And Fibonacci did some work, particularly around this fabulous building. It's a 40-story building, and it covers an area of 13 acres. And it's a massive project when you consider when it was done and how it was done. It's really interesting from a mathematical perspective is if we take the outline of the building, and you can see that we've put a right-angled triangle representing the height of the building and also the slope of the building. But if we look at the measurements, use of the triangle is 612.01 cubits, and the base of the triangle is 377.9. So the relationship between the hypotenuse of the triangle and the base of the triangle is 1.61950. So we're about 1/1000th of a cubit out from a direct reference for the Fibonacci series. We've just got a little bit more homework to do here on these numbers to make sure that everything comes across and makes sense. We've got 61.8% of a number takes us backwards in the chain, 161.8% takes us forward in the chain. But we can go back 2 spaces or go back 3 spaces, and we use these new ratios for that particular purpose. So 61.8% of 144 gives us 89. And if we use 38.2% of 144, that takes us back 2 numbers in the chain to 55. And again, if we take any number and use 23.6% of any number, that will take us back 3 numbers in the chain. So it's a fairly simple process. All we're doing here is accumulating the knowledge of the numbers and of the ratios. And again, if we want to go ahead or forwards in the chain, I've just chosen 34 to start from. 34 times 161.8 takes us to the next number. 34 times 261.8% takes us two numbers in the chain. And 34 times 423.6 takes us three numbers ahead in the chain. What we have in summary is some numbers here that are very relevant by adding the two previous numbers together to get the next number in the sequence. If we want to go backwards by mathematical calculation anywhere in the chain, we go 61.8, 38.2 or 23.6. If we want to go forwards in the sequence, we use 161.8, 261.8 and 423.6. So that is the numbers and the ratios of the numbers that we use. So now that we've done our mathematics lesson, what we want to know is how do we use this in the stock market so that we can make better trades, so that we can find important pressure points on a chart. And that's exactly what we're going to do now. On the next graphic here, what you can see is a typical screen chart of a software package, and most of them today have a Fibonacci ratio on them. And what I've simply done for the purpose of display is I've said if the market creates a low at $10 and a high at $11, what I want to know is when the market pulls back from $11, at what point is it going to start climbing again? That's what we all want to know. But we need to have something that's reliable and consistent. So what the Fibonacci ratio tool does, you can see we've got the ratio 61.8, 38.2, 23.6. What our software package has simply done is it's calculated the distance between the top and the bottom, and then taken those ratios that we looked at earlier and calculated the distance or the price measurement which would fit with that ratio. And you can see through here we're going forwards in a sequence by using 161.8, 261.8 and 423.6. A very simple basic tool that you'll find in virtually every software package out there today. Some of them also have included 76.4. Now the reason that's included is a simple balance mechanism, and that's all it is. If we looked at a starting point and a finishing point, one of the very important things I learned very early in the piece from some of Gann's work was that the 50% level, or halfway between a high and a low, is crucial to look for changes of trend or direction. And that's, if you take just one thing out of this seminar tonight, it would be that the halfway between a high and a low can create major changes of trend that you can profit from in trading. But what we've got through here, the blue arrows simply divide the starting point to the middle and the middle to the ending point. And the red arrows, 38.2% is the same distance from the top as 61.8% is from the same distance at the bottom. And this is where 76.4 comes into play, because from the top down to 23.6 is the same from 76.4 down to the bottom. So all we have is just a simple balance mechanism that's nice and neat, and it's balanced out evenly for us. Okay, let's now get into the good stuff. And what we want to do now is to see how these things work in a market. Now you can see that what we're looking at here is the ANZ Bank. This is one of the top 4 banks in Australia. Anyone can trade this market, and what we have got here is a graphic showing you a top was formed February 15, and the market pulled back until it made a low on March 15, and then the market turned around and it started a rally. Now when it starts a rally, what people want to know is how far is that rally going to go? Where's it going to stop? When do I get in? When do I get out? Any of those questions most people will ask from time to time. Well, what you can see that I've done through here is I've put the Fibonacci retracement tool on between the top and the bottom, and I've marked here at point A and point B where 38.2%, that Fibonacci ratio, is a support and resistance level for market trading. Now you can see at point A, which is early April, the market got up to the Fibonacci level, and then the market created what we call an outside reversal bar. Now, in case you don't know, an outside reversal bar, in my software or market analyst, I've coded it blue. And what it means is the market's gone higher than the previous day, but it's also gone lower than the previous day, and it's a very important signal of indecision. The market doesn't know whether it's going to go higher, and it doesn't know whether it's going to go lower. Indecision is death in the markets. Markets hate indecision. But for an educated trader who knows about the Fibonacci ratios, now what I've got is a signal of indecision at an important price. Now you can see that the market pulls back for 3 or 4 days, and then it turns around and retests the same level again at the Fibonacci level. Now when you see a known pattern like a double top, and I'm sure that we all know what a double top is, it's simply a price where the market's retested twice and is unable to break through it. And for those people who are watching carefully, they'll know that this means resistance, and if the market can't go higher, traders will get impatient, they'll get out, they'll sell their shares to look for something else that will go higher. And if it happens to be at a Fibonacci ratio with a double top pattern, there's a very good chance that this market is going to have an important decline, and that's exactly what ANZ has done. It's important that we recognize we have pattern, we've got outside reversal bars, and we've got price. What WD Gann told us was that we need time, price, and pattern. But we're going to have a look at those factors as well. But let's have a look now. It works on virtually any liquid market. And what I've got for you here next, the foreign exchange market of the Great British Pound against the US dollar. Now this is a massive market. There are billions and billions of dollars changing hands every single day. Now what we see here is that the Great British Pound made a major high November 3, 1980 worth $2.44. By February 25, 1985 it made a major low where it was just on parity, just above. You can see that the market was in a very strong downtrend, and then the pound started to gain in strength. Now what we want to do is we want to know where's the safer place to buy or sell foreign exchange. Traders today can make an awful lot of money out of foreign exchange. It's volatile, it's liquid, it trades 24 hours a day. But what we want to know is the safer setups. Now what I've simply done here is look at the rest of the history for the Great British Pound against the US dollar, and I've marked with arrows where the Fibonacci ratios have been important signals of price for this market to change trend or change direction, and some of them are quite remarkable. Now remember, this market trades billions and billions of dollars every single day, and yet there are traders out there who will tell you that this Fibonacci stuff doesn't work in the market, doesn't have these sort of reactions, but it does, and we're proving it here today. What we're going to do now is just zoom in on a couple of these major turns. On June 12, 2001, this market got to the exact price of that 76.4% level, and it is not 1 pip out. It got to 1.3682, which is exactly the Fibonacci level, and then it turned around, and as you can see, it raced up to 1.48. Now there's 1,200 pips of movement in a foreign exchange market after it's done an exact strike on a Fibonacci level. Now the other major turn was November 9, 2007, and this particular top came in and it went about 8 pips over that Fibonacci line. So what we've got is a very powerful price mechanism for watching changes of trend or direction. You can see at 2.11, this market fell all the way down here to 1.93. So there's another fabulous 1,000 or so pips that are available in profit by just a very simple technique on all software packages. They all have these things within them. What I wanted to do at this point is to introduce you to the other major influence in my trading, and that is of course WD Gann. Now, what Gann did was quite remarkable in that he was the first trader to recognize that time is more important than price. Now, we've just seen a couple of fabulous examples of the price on stocks and in major currency, but Gann was saying that it's more important to look for timing factors. He said that the markets will not move until the time is right for the market to do so. And what we're going to do is to have a look at what he did that was so unique and so remarkable. Now, he learned to read by reading via the Bible, and in doing so, he recognized that there are numbers and codes in the Bible that work and work exceptionally well on trading markets. So what he was doing was looking at numbers, and he was looking for them in time, whereas most, if not all traders prior to that, were only working in price. Now, this screenshot we're looking at now is a stock called Bradford Kendall, or Bradken in Australia now. And you can see that it made a major top 16 March 2012 at a price at $8.68. Now, if you remember the previous screenshot where Gann had those numbers coming back, and what we'll do is just go back to that chart very quickly. What you'll see is that at major tops and at major lows, he just started a time count. You can see these numbers, 4, 8, 12, 16, 20. So every top that's come in and every low that comes in, he just starts a time count. And what he's doing is he's looking for these Fibonacci numbers, looking for these important numbers to try and find where the market could have a change of trend or a change of direction. Now, if we have a look at this Bradken chart, what you can see from the top 16 March down to the low July 25, 89 days have passed. Now, 89 is a Fibonacci number. We just saw that on those sets of numbers. And here we have 89 days, and then from a low price of $4.62 at the end of July, by the end of August, it's at $6.40. So it's had a fabulous run, and the timing factor that Gann discovered is that the Fibonacci numbers work in time on a chart. Now, there's a fabulous example here that I wanted to show you on the Commonwealth Bank. Now, on the Commonwealth Bank, again, which is one of the top 4 banks in this country, we can see here that in 2007, it was trading at $62.16, and it fell down to beginning of 2009, down here to $24. Now, again, what we simply do is we put on the Fibonacci retracement tool, and it tells me between the top and the bottom to watch carefully when and if the market trades at $33.02 or $38.59 or $43.09 or $47.59 or $53.16. So those are the Fibonacci numbers in price. And those are the numbers that I'm going to watch to see what the market does when it gets to those levels. Now, you'll see the red arrows. These are just a couple of quick examples that I've put on through here. They don't always touch them exactly. Sometimes they might just sneak over them, and the next day they turn around and bump up. But you can see through here a couple of very good examples of the price becoming a major turning point for CBA. Well, what we're going to do in the next graphic is we have a look at what Gann was doing, because he's combining the price and the time. Now, you can see that there's that 38.2% level, and there's the $53.16 level. There's one of the last of those red arrows that we looked at previously. You can see the market was in a downtrend, and in March it got down to the 38.2% level. There again is my pattern, the outside reversal bar, a signal of indecision in the markets. I've got 2 inside bars, so I've got 3 days where the market doesn't know whether it's going to go higher or lower. But once the market breaks this trend line, which every trader knows how to use, it's an indication that the trend is going to run up. And you can see it does 1, 2, 3, 4, nice little Elliott wave pattern. And when it gets to the top, you can see through here, $53.16 is the Fibonacci level that we watch for changes of trend or direction. And $53.09 is where this market tops out. But the important thing here is the 55 days, because 55 is a Fibonacci number. So at this top, we have what Gann called a conjunction of time and price. In other words, a reason in time being a Fibonacci number where the market might change direction, and a reason in price where the market might change direction. So the two of them combined give us an excellent clue that this market may well now start to come off, especially as it's been up and had a very good run. So again, educated traders put these tools on their charts and they watch carefully what markets do around these numbers, but also around these important time counts. Now, numbers govern our lives. They're absolutely essential for us. We can't live or exist without numbers. And one number in particular is very, very important, probably more so than any other number that we can think of. And that number, as Gann told us in a lot of his books, sometimes in a coded format, but the number 12 is crucial. And I've just listed a couple of examples here why the number 12 is so important. We have 12 months in a year. We have 24 hours in a day, which is 2 times 12. We have 60 minutes in an hour, which is 5 times 12. 60 seconds in a minute again, 5 times 12. There are 360 degrees in a circle, 30 times 12. There's 12 zodiac birth signs. There are a lot of different reasons why 12 is very important. But also, from Gann's point of view, reading the Bible and learning to read by reading the Bible, there were a lot of references to the number 12 there. 12 apostles, 12 tribes of Israel, 12 pearly gates, 12 angels, the New Jerusalem walls, 12 precious stones, walls 12,000 furlongs long. The tree of life yields 12 different fruits. So this number 12 is very, very powerful. And at one point, Gann told us that the number 144 was the most important discovery he ever made when he was trading in the markets. So we're talking about 12 times 144, or 12 squared. And again, some fabulous references for 144 in the Bible. 144,000 people in the rapture. The New Jerusalem walls, 144 cubits thick. God created all things in 6 days and rested on the 7th. And that's an interesting one, because 6 days at 24 hours a day gives you 144. So what Gann took that to mean was that the number 144 is an exceptionally important number in the markets to watch for. And let's not forget that the number 144 is a Fibonacci number. The Fibonacci series can quite often be called the golden ratio or the law of 3, but 144, or 12 times 12, is within the Fibonacci sequence. So it's a very powerful number to watch. And what we've got through here is a couple of examples now to show you why the number 144 is important. And we don't look for precision, because if you look for precision in a market, you probably will not find it, very, very rarely. Because when you think about it, markets are traded by people who want to make money. And you'll find that sometimes when they get greedy, or sometimes when they panic, their head will overrule the heart and they do silly things. But if we look very closely, what you can see was this is the Euro US. Now this is a foreign exchange market, probably the largest market in the world today. And following Gann's example of just starting time counts from major highs and major lows, you can see the top came in on 7th of June. Now we count 142 calendar days, and you can see a major top came in the 27th of October. 143 days here, it's a little hard to see, but it's a very small inside day. And 144 days is a very steep decline. So what we've got is a magic example of 144. What you can see from this important low, there's an important low here, October 4, where the market has a strong run. 143 calendar days later was this top, which came in February 24. Again, another fabulous example of 144 turning a huge market. Again, this market has billions and billions of dollars every single day, and yet it still works to these Fibonacci numbers. Now, from this top in February to this next top in September is 145 trading days apart. The important thing to take from this slide is the fact that the market can change direction on 143 calendar days or 144 trading days. Either one can change the market. So if you want to adopt this technique, what you need to do is count for both calendar days and trading days. And if you've got a software package like Market Analyst, they have the tools that will do this automatically for you. You don't need to sit there and count them. It's 2 mouse clicks and you'll know exactly when the next 144 count comes into play. A major stock, Rio, one of the largest mining operations in the world today, made a major peak early February 2012 at $72.30, went through a very serious decline. We had a 1, 2, 3, 4, 5 Elliott wave structure for those people who follow Elliott wave. You can see that it made its yearly low at $48.37. Now, the big clue is that the distance between the top and the bottom in time is 144 trading days apart. Now, 144 trading days apart means that we start watching the chart, we start looking for any indications of change of trend or change of direction. And you can see through here that once it starts to put in higher top, higher bottom swings, the Dow theory, for example, or you might like to use RSI, stochastic, Bollinger Bands, CCI, moving averages, whatever you like to use. If any of those tools start telling you there's a change of trend about to come in and there's a significant time count, then you know that there's a very good chance that that change of trend is going to be significant. This low at $48.37 in August, by December, this market was trading at nearly $70. There was a huge profit in there. And all we had to do was count these numbers. Now, I've got another fabulous example on the same stock. Again, this is Rio. And what we can see here on the top, May 19, 2008, Rio was trading at $124. It lost $100 per share. So it was trading at $124 in May. In December, it was trading at $23.59. That was a massive decline in that market. And you can see here that the time count between the high and this low is 143 trading days. 144 was an inside bar, and then this market started to take off. So after it's lost $100 a share, it's trading at $23.60 in December. By June, it's trading at $80. Now that represents a 400% increase in the price of the stock after it's done a 143-day count from top to bottom. So hopefully now we can see that it is well and truly worth following these numbers to see when they can create a change of trend or a change of direction. Again, let's have a look at ANZ. This was one that we looked at earlier, and you can see through here a major top came into play early in May, the 1st of May 2012. And again, if we follow Gann's example, 143 trading days later, this market makes a low, and you can see it went sideways for about 5 or 6 days. Now that's a crucial signal. It's a crucial signal. If the market pulls up or changes trend on such a significant number and then starts to rally, there's a very good chance that there is a potential profit in that market through there. Wanted to give you some examples on markets that anyone can access irrespective of where you are. The Australian dollar, US dollar, this is my home country and the currency that I trade. And you can see, following Gann's example again, 9th of August 2012, if we go and maintain this time count, you can see here, 89 trading days later, on December 2012, this market started a decline, and then it retested that decline and went further. Now, if you actually go through and look, particularly in currencies, because they're huge markets, what you will find is there is a plethora of these numbers that will give you opportunities. All you have to do is just do the work and do these numbers and watch to see what they can provide. This is the Australian dollar US dollar foreign exchange chart, but now I'm looking at a weekly chart. So we've looked at daily charts. The fabulous thing about this technique is they work on daily charts, weekly charts, monthly charts. Any time frame that you want to trade in, you'll find that these particular numbers can be very effective. Now, in October 2008, the Australian dollar was trading at 60 cents. It made a major basing pattern through here, and it climbed up, as we all know, until 2011. The Australian dollar got to $1.10. Now, the distance between that low at 60 cents and that high at $1.10 is 143 weeks. Now, we know 144 is a very significant number. And have a look at the pullback that started at 144 weeks on a massive foreign exchange market. Again, billions of dollars changing hands, but this number and these Fibonacci numbers have pulled this market up. Now, I said to you we can use this on any time frame, and again what I'm doing here is looking at the Aussie dollar US dollar monthly chart. Now, quite recently, there was a lot of talk about whether the Australian dollar was going to have a major pullback. And what we simply did here was to have a look at the longer term charts, the monthlies, the weeklies, and the dailies. The Aussie dollar made a low at 47 cents on the month of April 2001. And 144 months later, in April 2013, or 12 years, 144 months, it was trading at $1.05. Now, if you have a look carefully at that chart, you can see there was strong resistance there around 106. So the Aussie dollar was trying to get back to that $1.10, and it couldn't do it. Every time it tried to get up there, it just get pushed back, pushed back, pushed back, and it was really struggling to climb above that figure. Let's now look at the same market, but on a weekly chart. The major top came into play, $1.10. in July 2011, and here on the weekly chart we have a count of 89 weeks. Now, 89 is a direct strike on the Fibonacci number. So what we have is in April 2013, 144 months and 89 weeks all coming in around the same zone. But if we take it one step further and drill down, if we look at the daily chart, what we can see is the distance between the two tops here on the daily chart is 90 calendar days. Now, 89 is the Fibonacci number. 90 is a number that Gann worked with very heavily because it's a number that means change, obstacle, or redirection. And what we can see here is we've got 90 days between these 2 points. So when we look at it in summary, what we have got is a fabulous example of how the Fibonacci numbers pay off handsomely. At this point in April, what we had was 90 days from the previous top. What we had was 89 weeks from the major high, and we had 144 months from that very significant low, and it all came in around the same time. Market was really struggling to break through 106, then it declined, put in a slightly lower top, and the rest is history. So if we simply maintained a count on these charts and watched what they did around these significant numbers, we could have had a very successful trade. What I do to help people understand the Fibonacci series on my website every week, I just find a little example. It takes me 2 minutes to do. But what I do is I find an example. One week I'll look at commodities, the next week stocks, the next week I might look at currencies, and I just simply put on a little free review that anyone can access to show you another example of why these numbers are so important. Now, this is oil. Now, it's probably the most important commodity in the world today. Again, if we followed Gann's lead and started a major time count from the significant tops and bottoms, top came in here January 30. Now, oil made a major peak here August 28, and it was exactly 144 days from the top in January to the top in August. Oil was trading at 112. It's now trading around 90. So there's another example of these numbers working in a very strong commodity market like oil. The S&P 500, for example, one of the most closely watched stock indices in the world today, 500 stocks in the US, and all fund managers, institution banks, they all watch this chart very carefully as a lead for the strength or the direction of the US economy. Now what we can see here, it made a low June 4, it made a top September 14, and all I simply did was put the Fibonacci tool between the low and the high, have a look at one of the largest stock markets in the world, how it reacts to these Fibonacci numbers. November 16 here, it went over by 1 or 2 points and then started a very strong reversal. You can see a double bottom low here, virtually tapping right on the 38.2%. And again, what we need to do is to have as much evidence as we can. But when we look at the same market, what we can see, the low in the 4th of June to the low here, the 31st of December, 144 trading days apart. Another conjunction of time and price, which means that there's a potential for this market to have a very strong reversal. And look at the run. I mean, you've only got to look at these. You cannot argue with these things. They are there in black and white. And you can see here the low at 1394. Well, the S&P is way above that now. Fabulous opportunities for just a couple of minutes work on your charts. We've got to have the knowledge and the understanding. But the important thing is that these numbers do work, and they work in all and every liquid market. You've just got to apply the tools. What I have done in my book, I've produced a forecast. I don't like to produce major forecasts because obviously what you find is that you cop a lot of flack if your forecast is wrong. But I think this one was important to get out there because the ramifications are huge. Now, Gann used numbers for forecasting because he could look at the numbers. When you get a conjunction of numbers like we saw on the Australian dollar, 144 months, 89 weeks and 90 days, it's fairly good chance that that is going to be a major reversal in the market. But what we're going to do now is to have a look at a potential forecast, and I stress that this is a potential forecast. And in all honesty, I hope I'm wrong, I really do, but I see some really dark storm clouds coming, and what we need to do as individuals is to be ready for it. Now, the Fibonacci number 89 is very close to the number 90, which is the main number that Gann used. And number 90 in numerology, because each number has its own specific meaning. It's a very esoteric study. But the number 90 means change, obstacle, or redirection. And one of the easiest examples I can give you of that is the square. And if we think of the square, it has 4 corners inside it, and each corner is 90 degrees. And that is a classic example of change, of obstacle, or redirection. And when we look at this, we look at when the last Great Depression was. Now, what was surprising for me when I was doing this presentation around the country was that we seem to have forgotten history, and we do that at our peril, because markets and human beings only ever repeat, and I'll prove that to you in a second. But the last Great Depression was in 1929. Now, 1929, huge unemployment, a massive breakdown in financial circles, and it was a very tough period around that date. But very few, if any, people know when a previous depression to 1929 was. And when we look at that, you can just Google this. That's exactly what I did. The previous depression was 1837. Now, when we look at it, interesting, on Google, the Panic of 1837 was a financial crisis, an American financial crisis built on speculative real estate, a classic example of human beings repeating the mistakes of the past. That's why it's so important not to let history go. We have to remember these things. The panic was followed by a 5-year depression with the failure of banks and high unemployment levels. We've just seen a repeat of that. What's important for us 1837 to 1929 is 90 years, give or take a year or so. So we know that these things are not exact, they're not precise. But 1929 plus 90 gives us 2019. So what we're simply saying here is that we have a potential to see a major economic upset or earthquake around 2019. And when you look at the square, the numbers just fit. They fit nicely, with 90 being a change of trend or a change of direction. We've seen it on daily charts, weekly charts. All we're doing here is putting it into yearly annual basis. So 2019 could be a very significant time. Now, when we look at the timeline, 1929 depression, 90 years brings us to 2019. And the 50% or halfway point that Gann told us was very important to watch. This time we're looking at it in time, the most important factor, we're looking at it in time, not in price. Now, halfway between 1929 and 2019 was 1974. And if you know your history, there was a massive crash. In fact, some people, they say the crash in 74 was much bigger than the crash in 1987. But it's exactly halfway between 1929 and 2019. We've just had a global financial crisis, and that started the end of 2007. Now, 2007 to 2019 is 12 years, that all-important number, or 144 months. So all we're saying now is that there is a real threat, that there could be a major financial earthquake somewhere around 2019. Now, because these things are not precise or exact, what I'd suggest is that I will be watching the market very, very carefully for a sign of a major top somewhere around 2016 to 2019. My own personal opinion, for what it's worth, is that next year, 2014, we should see a dramatic decline in prices, particularly if the US does start to try and taper back its money printing scheme. 2015, 2016 are very likely to be bull years because they typically are. History shows us that they are. At the end of 2016, 2017, if we see a major top that looks anything like the 2007 top, then we're very likely to see a repeat of the major panic of 2007 and possibly even worse. So what we need to do as individuals is to be prepared. Now, each person will have to work out for themselves how they insure themselves against any great financial earthquake that may turn up. As I said, I hope I'm wrong, but the numbers do not lie. We've seen them on the charts, we've seen them time and time again. I can't tell you the number of times that I've seen the Fibonacci numbers working on charts. It would be literally tens of thousands of them. Now, what I have done for those people who want to take it a little bit further and perhaps learn a little bit more, I wrote a book many years ago, which I've just recently updated. And the book is called Trading with the Gods. You can get that on the website, tradingwithgods.net, and it goes through the presentation that I've given you this evening, but it has got some more information in there as well. So there's a lot of interesting info in the book that I don't have time to cover tonight, but that's a little opportunity for you. I mentioned earlier that on my website I produced some free videos for you to watch. That's my website, tradingwithgods.net. All we need to do here is to go into the login page, which is the last menu item on the right hand side, and if you click on that, you'll see a list of videos. There's a little section called General down the bottom, General videos down the bottom through there that you'll see on that page, and there are a little library of examples like the ones that you've seen tonight that will give you proof, if you need proof, that these numbers do work in all markets. It just requires discipline and patience for us to go through and use them. So that brings me to the end of my presentation, and what I would say to you is that if you do need any guidance or assistance, I'm more than happy to help traders where I can. I wouldn't be where I am today if people hadn't helped me. So I'm quite happy to do what I can to help. I'm limited in what I can do. I can't give you financial advice. I can't do financial planning, and to be honest, I wouldn't want to do that. I make a very good living trading in the markets, and I'm happy to pass on what I have learned. What I will be doing is working heavily with Davin and the boys at TradeDirect to write some more information and more materials for you, and we'll put together a little learning package where you can go in and start trading effectively. It's not hard to do. It just requires some dedication and some persistence from traders, and then you'll find that you'll have an excellent opportunity in the market. So I think that clearly covers it from me. I have got a couple of questions here that I'll come through. Thank you, Keith. I'm delighted that you enjoyed that presentation. There is a query here. Most of my charts have been in retrospect. How do you put Fibonacci tool on a current chart? That's very, very simple. What you do, and this is another fabulous thing about the Fibonacci series, is that there is no wrong place to put the Fibonacci tool on there. Any high to any low. If you're a trader who likes to be in the market for 3 or 4 days, then you would probably need to have a smaller time frame chart. But if you want to hold a market for weeks to months, then look at a much bigger picture, maybe a weekly chart or a monthly chart, and that will then give you the opportunity to have a look at longer term. But if you just go through the process and put the Fibonacci tool on any high and any low in a time frame that you wish to trade it in, and then watch what the market does when it gets to those percentage ratios, I know that you'll be absolutely blown away by how good these particular trades are. I wonder if market analysts might offer some special pricing or a trial version from D. D, yes, absolutely they do. If you have a look at the bottom right-hand corner of my website there, you'll see there's a little market analyst software icon. Now, if you don't have market analyst yet, you can click on that, and it will give you a 30-day trial. And if you don't own it and you do go through that particular icon there on my website, I can wangle a little bit of a discount for you, because I'm quite happy to send a lot of business to market analysts. It's a fabulous software package. So click that link, have a trial, and if you like it and you want to go ahead with it, to let them know that you're one of my clients, and they will give you a discount. So I hope that really helps you there. A question from Matthew. How much emphasis do you place on 15 and 30 degree time counts and contract birth time counts? Matthew, absolutely. You're really starting to get into the advanced Gann material there. But Gann also used major highs, major lows. He used anniversary points and also the starting date of the contract or the market or the stock. And he used to count in solar degrees, which is a whole nother area of study. I've done a little bit of a video presentation on that for people who want to learn that. You can see that in the Learning Center, but you're absolutely correct that he did do time counts, but he focused on major highs and major lows, and just exactly as we've done today. It is a fabulous area of study, and on that website in the Learning Center, you'll see that I've done modules for people who want to learn this material. I've done one on the Gann swing chart method, one on the square of 9, which is another fabulous tool. I've done a full package of the whole Gann suite of tools there. So if anyone is interested, then you're more than welcome to go through that area. And of course, if you do have any questions or anything you want to know about, then you're more than welcome to get in touch, and I'll be happy to help you through that. Bob, was this recorded? Absolutely, and it will be placed. Trading Direct will have that somewhere on their website, and possibly later on I might be able to wangle a copy and put it on my website as well. But it was definitely recorded, and you're more than welcome to have a copy of it and to go through it, you know, step by step, slide by slide, and figure out and learn from some of these things, because I can only tell you after 20 years in the markets that these are one of the better signals that I've ever found and used, and that's why I've stuck with them. You're very welcome with that. What I will do now is to say thank you so much for attending. I hope you've learned something from that. Please get in touch if I can assist you, and I'll hand you back to Davin.